Hello world, this is producer Cam, and on behalf of the Tackle Trading team, we'd like to bring you a sneak peek of our weekly coaches show. Our coaches show is every Tuesday at 7 Eastern. Traders gather from around the world to get a peace of mind for a piece of time. Enjoy this conversation with Coach Matt Justice and Tim Justice and the strategy better known as the Straddle.
There's a strategy called the straddle.
Mm-hmm.
And the straddle is a strategy that we do when we expect volatility to increase in the market. It's what is known as a bi-directional trade, which means you make money if it goes up, you make money if it goes down, you just don't make money if it does what, guys? Make money up and you make money down. Just sideways, exactly. So this is a two-part trade. Part number one is you are going to buy a put option. Part number two, you are going to buy a call option. The whole purpose of the trade, however, is when we expect volatility to increase in price. And we got a couple case studies we're going to work with you on here in a second. But Tim, take a moment and explain the straddle for all of our listeners.
Sure. And now there's a couple of things. Number one, there are tons of resources out there that we already have. There's some options, 201 videos, vol build, vol crush. You can always reach out to us. You should also have a playbook, especially if you came through one of our events. You got a master playbook. The rules will be in there. Guys, essentially what I'm saying is if you need some detail on this, reach out to us after. Twitter, Facebook, Clubhouse, you name it, will help you. So I want to keep it high level. What a straddle is where you buy a put and you buy a call on the same stock at the same time. Now, yes, Matt, you can make money if it goes down far enough or up far enough. But really, the nature of this strategy is where we're trying to build profit even if it does not and it just stays in the middle, but the volatility increases. Everybody type in the word volatility. See, if I can spell volatility, okay, volatility.
VOL is just fine.
Yeah, I got it. Volatility is that extra component. It's something traders look at. In fact, a lot of traders, they focus so much on volatility, they build their systems around volatility. It gives you an edge, guys. And the reality is it can help you make more money. If you understand volatility, you will be a better trader. That is a firm belief of mine. I know that to be true for myself. One of the keys to my success over the years, Matt, was when I started to really dig in and understand how volatility works. Now, what we're going to do is we're going to teach you this by using a few case studies. But before we go into the case studies, I'm going to draw just a very simple way to explain this. And when you have earnings, and guys, how often does earnings come out? Give you a quick quiz question. On average, for most stocks, it comes out every
quarter.
3 months, right? Every quarter.
Every 3 months.
So when you have earnings coming out, you can break those down into volatility boxes. And essentially, Matt, it goes like this. The volatility will increase as you anticipate earnings. So from the bottom to the top in those 3-month cycles, the volatility will start to go up as you get closer to earnings. And that's what we're dealing with right now. Right now it's June 13th. Earnings season is July. So many companies, most of the S&P 500 and most of the reporting cycles in a market are going to happen in July. So we're about that perfect window out to start putting this trade on. Because we're at the bottom on many of these to where we think that it's going to start to build into that earnings report. And I think one of the best ways to teach this, Matt, would be to use some of those case studies. But anything to add to that real quick?
Yeah, I just got a question for you, Tim. Why is it that implied volatility increases dramatically going into earnings? What is the reason for the consistency we see for volatility going in and volatility crush coming out?
Well, my daughters are at a theme park this week. Today it's called Lagoon. You ever ridden a roller coaster?
Oh, yeah.
Okay, so think of a roller coaster. Guys, what's the feeling you get when you get in the coaster, you get strapped in, and you start climbing the hill, right? You get butterflies in your stomach. It's the anticipation. Now, you're actually moving really slow, right? But you know what's coming. See, that feeling of you getting on the coaster and start going up, slowly up the coaster before the big, big drop at the very, very top, that's the reason why volatility builds up. The top of the roller coaster ride is the earnings report, Matt. Traders know that a company can move 5, 10, 15% in one day just from the earnings. And so we know the big flashy ride, the fast movement, the craziness is coming up in front of us. And it's just that anticipation. So what is happening
Yeah.
in the options market is that market makers and traders are buying those options because they're wanting to protect and play the ride. They're wanting to ride the roller coaster is what it comes down to. And that's where the volatility starts to build in. You take any of your companies, by the way, you can add implied volatility at the bottom of your charts, right? And if you took any of your companies, Matt, one thing really kind of neat to look at, and I do this with my mentor students, is we'll go and track implied volatility cycles as they go up and down on the chart. And this is where this blue line comes in down here. You'll notice like a period like this where it went up. That was right before Apple's earnings, right? A period like this where it rose was right before Apple's earnings. Didn't happen every time. This one was more flat, right? That's why it's an indicator probability thing. This one went up. So during and before that event, before the roller coaster top, you have volatility rise, 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 and then it falls. It rise, 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 and then it falls. And the bottom line, and this is my understanding of markets, after trading for 12 years now, if you can have something predictable, you can make money on it. There's a way to make money on it.
Yeah.
And volatility is one of the most predictable things that you can use, right? So that's it. By the way, real quick, fun question. What's your favorite roller coaster in the country or in the world? Mine is in New York City. Yeah, absolutely. Kind of I gotcha. Not applicable. He's not into roller coasters. He's into trading, Matt. But hopefully that helps explain
Paul
it.
Butter. Paul, my marriage. That's
I got
awesome.
it.
Jason, the Hulk at Universal in Florida. I've done that one. I love it. Cedar Point Drag Racer, the Titan, Six Flags. We don't have anything like this in Utah, Tim. We got a couple
Got a
of
couple
decent
fun
ones, but
ones.
all right, Tim. So let's do a case study. Let's do
Well, let
Biogen.
me ask the
Let's do
class here
BIIB.
real quick. Guys, we generally do our rapid fire at the end of every coach's show. Do you mind if we cut that in half and extend this conversation a little bit? Matt and I are always a little bit long-winded. Is that all right? Because I kind of want to go through these case studies. So Matt, maybe we'll do a 5-minute rapid fire, and then
Yeah, that's fine. We don't want to cut this one
I
short.
agree.
This is good stuff.
So we had case studies. You and I picked some, right?
Yeah.
Okay. Which one do you want to start with?
Let's do Biogen. Let's BIIB.
Okay, BIIB. Now, there's several things about this. Biogen, and this was one of our picks, Matt. You and I were on the phone. We were talking about it.
Yeah.
Biogen is in the healthcare sector, but specifically in the biotech sector. Biotechnology is a high volatility sector in general. Biogen is one of the biggest companies out there. I liked the pick. Now, there's a couple of things as we look down here at the bottom. Volatility is extremely low. 21% volatility, Matt, for a company like Biogen. It's not been there in a year. It is the lowest point. So here's the simple.
Especially Tim,
Mhm.
in a downtrend.
Sure, sure. And
Yeah.
here's the simplest way I can explain what that means for options. When volatility is low, options are cheap. Type in options are cheap. Now, guys, if options are cheap and you know that we're getting ready for a roller coaster where the markets are going to move, it's time to buy options. Type in time to buy options. So this is where we're at the bottom here. It's time to buy. A straddle is the type of technique that you can take advantage of when you're in a condition like that. So earnings out here, Matt, would be 721. Now let me ask you, because you wrote the playbook rules on this. I remember when you designed it. You like 4 to 6 weeks in advance. We're exactly 5 weeks out from this. Are we in a sweet spot here? Is that kind of what you like?
We're in the sweet spot, and when we designed those rules, guys, 4 to 6 weeks out, we took into account, okay, when does volatility, not just on Biogen, but when does volatility on most stocks, the majority of the market, when does it on average start moving back up? And what we had found was 4 to 6 weeks out in back testing systems and whatnot. We found that 4 to 6 weeks was about the time away from earnings where we started to see that increase in price. And that's right. That's right about where we're at right now. Is right about 5 weeks before Biogen's earnings. So this is the ideal time from a timing perspective to trade the straddle as it approaches earnings. Now, obviously, guys, what we want to do here with the straddle is we want to take out the directional posture. This is purely a volatility trade. That is all it is. Some of the times we get so caught up in technical analysis and economics and market cycles and all this jazz that we don't realize what the core of everything is. And Tim said it earlier today, and I'll say it again. Traders, investors, people have a tendency to make things harder than it is. Okay.
Mm-hmm.
Now, Tim, please kind of make volatility bigger so that we can kind of see the volatility.
Sure. Here's volatility.
Now, all I'm saying, guys, all I'm saying here, this is the entire strategy. I'm saying that blue line is going to go up over the next 6 weeks. Now, how many of you agree after what we just talked about and after you've seen this study that volatility will go up over the next 6 weeks? That's all I'm saying. I am saying a blue line is going to go up. Now, guys, on the scale of difficulty, right, on the scale of difficulty when it comes to anything in life, I do not think that's very difficult to say that that blue line is going to go up in front of the earnings. Would you agree with that? That is not a difficult thing to do, right? Okay, very, very simple, right? So now what we're going to do to take out the directional component of this trade is we're going to buy both a call and a put option.
We're going to play both
The reason
sides.
we buy both a call and a put, ladies and gentlemen, is to take out delta, to make sure delta is not a concern, and if volatility increases, the net value of the options should increase. Does that make sense, everybody? Now, if delta does start moving dramatically one way or the other, like for example, come back to Biogen, Tim. If I'm looking at this technically speaking, guys, I'm seeing a bearish retracement where the stock could start coming back down fairly aggressively. Okay, how many of you guys see that technically as well? You see a bearish retracement where the stock could. Okay, so if that starts coming down, guys, then I can profit both on delta and volatility. But that's bonus column. All I care is about profiting off volatility. So what we're going to do is we're going to go over to the Analyze tab, and we're simply going to apply the rules of the strategy. So what Tim's going to do, guys, is he's going to add, kind of delete everything, Tim, and show him how you add that to the trade to the Analyze tab.
By the way, just type in "trust the process" in the chat. Just trust the process. If you're in your first 6 months of trading, most of this should be exciting, but also confusing. Okay, so I do need to, as a mentor, to, especially for our community, make sure you guys know that it should be exciting, but a little confusing, because these are advanced concepts. In the Coaches Show, we're ready to go into that, and Eddie, that's a natural part of it. You know, this is why we always bring you in and willing to kind of show you this stuff. But now, if I go over here,
hey,
go ahead,
Tim, real quick, guys, listen. It's confusing to everybody if you've never done it.
It's just new. It's not that.
Can we all agree? Can we all agree with that? Confusing when you haven't done it, but it doesn't mean it's hard, and it doesn't mean it's difficult, and it doesn't mean it's really confusing. It just means you haven't done it.
It just means it's new.
And that's why we're doing it, guys, is because this is the time to add straddles. And so if you've never done a straddle before, what should you do tomorrow at some point? You should practice this trade over the course of the next 5-6 weeks.
That's right.
And not just do Biogen, do 7 or 8 of them, right? And if you have to watch what we're doing again, that's why we record everything. And if you have to post a comment in the clubhouse, then let's do it like that. But I love what Rob said. Straddle up. I agree with that. Let's straddle up. Let's go.
So now, if you look at this, we right-click, Matt, on any of the strikes. Now, the way that you're going to build a straddle is you're going to identify the price of the stock. Current price of this stock is $261. Find the strike price that is closest to that stock price. You right-click, you buy, straddle, okay? Now, if we take a look at this, it then will build in a call and a put. There are variables that we will not go through now on how to position all that. That's where you work with a mentor. And now what we have is we have what's called a V-shaped risk graph, Matt, where a trader is building a position where they can make money if it goes up, they can make money if it goes down, and also, now this is where it's really cool, they can make money even if the volatility simply goes up. Now, guys, we're not going to go through the details of the numbers, but I just want you to watch this. If the volatility goes up 1%, tell me what direction the lines move. It moved up. 5%. Watch that pink line. It goes up. 10%. It goes up. See how even though the stock, we're not even projecting it moving, this pink line is what we make from the volatility rising. If the stock goes nowhere and volatility went up 10%, you would have a $1,000 profit just right at the current strike. Now, Matt, again, if it goes up a long ways, or if that bearish retracement kicks in and it goes down a long ways, you could be looking at more profit on the one contract. But you can make money if it goes up. You can make money if it goes down. But the real key to this trade is that roller coaster. The fact that we're 5 weeks out from earnings and the volatility will rise, and we're expecting to have a profitable trade from the volatility just happening.
Yeah, and Esteban, to answer your question, how do you know what expiration date to pick? I would pick more than 90 days of time. So I believe, Tim, you did, if I had
We did
September,
94
right? It was like 94 days of time. So I'm going to go out about a little bit more than 90 days because I'm willing to hold the next 30, guys. And so kind of Esteban and everybody else, same rules apply when you're buying a straddle and when you're just buying a call option. You need to buy enough time that theta doesn't come back and bite you in the behind, right? We know theta is going to be a negative to this trade because we're buying both a call and a put. We know that's going to depreciate the value of the call and the put option. We need volatility to rise over the rate of theta decaying the options, which means we need to buy more time so that we have enough time to offset the theta. And Anthony, I think that's a good rule of mind. You know, the rule that most traders live under is 60 days plus expectation. If your expectation is going into the earnings date by 60 days plus whatever the time frame is that before that.
And I would just also add to that, everybody type in the word playbook. Okay, these rules are in your playbook. Matt wrote these rules. You know, so yeah, absolutely. Straddle is Matt's baby going way back. So definitely go into the playbook, check those rules out on that. They're in your playbook.
Every single one of you should have a copy of that playbook. If you do not have a copy of the playbook that I wrote, then just send team at Tackle Trading an email and I'll get one sent to you guys. Okay.
Absolutely. And now there's a lot of advanced tools, Matt. I think I'll leave for another coach's show, or maybe I'm doing the Cash Flow Club this week. Well, you know, I could easily, guys, would you like me to extend this exact conversation we're starting today?
I think we could do easily an hour on this. I think we could easily do an hour on this.
Here's a special treat. You get Tim for a full hour on Thursday. So I know, right?
Get to our partner page, Trading Justice, and sign up for a free 15-day membership by clicking the banner at the top of the screen. Listen to a few of our most recent podcasts and download the newsletter. If you want to educate yourself and get a quick laugh, this is the place for you. Tackle Trading and Trading Justice, the fastest way to go from the sidelines to the rafters. Get your jersey retired, and it all starts by getting in the game.